debate, but Sunil Subramaniam is also with us, Managing Director and CEO at Sundaram Mutual Fund. Sunil, good morning. It's a pleasure. Good to have you with us here, and good speaking with you on a Saturday.
Yeah, thanks.
Good to see somebody else wearing a tie. I was wondering whether I'll be seeing people in t-shirts and whatnot, but good to speak to you. I was just looking at flows, Sunil, big flows, right? Negative from FIIs, some 35,000 crores on the sell side, but mutual funds have kind of sort of matched that almost equally, bought in some 34,000 crores in the month of May.
Yes.
It is as I speak to you right now, do flows remain as solid in the SIP bucket and otherwise?
Absolutely. I don't think the Indian investor has any doubt about the future of the economy. And I think the shift from bank deposits to mutual funds is well underway. And I think the incremental allocation of money from people is coming into equities. And some of it is in direct equities, but mutual funds are able to gather a decent share. And I was just looking at something over a decade now, mutual funds as a proportion of bank deposits has doubled from 13.5% to 27% now. So clearly there's a fundamental shift in the investor behavior, driven largely by the massive efforts of distribution, individual distributors as well as banks, But I think that's a significant shift, and that's what is kind of making a big difference in the market, that valuations don't seem to worry people at all, especially if you see mutual fund managers. If customers are giving them money, risk management discipline will not allow you to take cash calls in a mutual fund of more than 5 to, let's say, maximum 10%, which means 90% of the money that comes in has to be deployed. So it's not like you can take a tactical call saying valuations are too high, I can't put. Customers giving you money, you have to find the best space. And good thing for domestic mutual fund managers is that FIs have been selling, which means that you are getting some stocks at fairly reasonable prices because FIs are selling. So I think all in all, it's a very healthy space at this point in time. If FIs were also buying, you can imagine where valuations would be going, because this money just can't be kept on the sidelines, if you understand what I'm saying, Prashant.
But is that a bit of a negative, that just because money is coming in and it's coming in hordes, mutual fund managers are compelled to invest it, it's irrespective of what the valuations are. So does that skew the, risk in the market in any way?
What it means is that the entire domestic mutual fund industry is pushed forward the earnings growth which they are discounting. So what's published in terms of valuation is 1 year forward PEs. But since the fund managers are taking 3 to 5 year calls on specific stocks, they are discounting those earnings for those 3 to 5 years, and where they feel that the net present value of those cash flows is better than better than the price, then it's worth buying. But from a 1 year forward, especially in the infra related pack, there's a high operating and high financial leverage for these companies. So what happens is, over the last decade, we've had a very slowdown in the capex building framework in our country. And this V-shaped recovery, which is about to happen, will mean that the earnings growth, if you look 1 year, 2 year, 3 years out, will probably jump at about 15-20% per annum annualized. So what's looking very expensive from a 1 year forward, right? So what will look very reasonable when you do a 3 year forward or a 5 year forward. Picking the right company which is actually going to post that V-shaped recovery is key. Got to pick the winners of the infra pack, because not every company will get orders. But that's where the expertise of the fund managers and the research is coming into play. So the risk is that if somebody is going to take a 1 year forward and look at it and say, oh, mid-cap index is at 20% premium to large cap, small cap is at 17 or 18% premium, then you try to get thinking, is the risk gone up? But according to me, since those fund managers are going to hold those stocks for a 3 to 5 year period, I would say this is a visibility issue, that the 1 year forward looks very rich and hence market looks expensive. I don't see a cause for concern as long as there's good quality stock picking, through analytics happening. And I do believe that's the case happening with the fund management.
Sunil, sticking to that capital goods entire space, right? Let's talk about, I put out a piece on CG Power, right? And of course, we all know the story of CG Power. I sort of put out a piece because yesterday, and I think once before this week, but this week, it hit 1 lakh crores in market cap. The Murugappa group, I'm assuming you're very familiar with the group from 100 plus year old group. They stepped in at a time of crisis, depths of COVID, bought it. And it's been an incredible, from the purchase price of 25 rupees, it's up 26 times. At the time when they bought in, I mean, not their purchase price, but at the time that they bought in November, the agreement was signed November of 2020. Now, the question is, you know, FY24, they did nearly 900 crores in profits, net profits, the company. They're saying they will double their revenues and profits in the next 4 to 5 years. Let's assume they double their profits. Let's assume profits are 1,000. They double it to 3,000 crores in 3 years, right? Now, you know, so 3,000 crores profits, market cap of 1 lakh crores right now. So you're essentially paying 30, 35 times 3-year forward P multiple. Would you take that bet, Sunil?
So I think that you got to look at various things here. Look at the quality of the management, which obviously is a big tick. Look at, in these companies, you also look at their ability to generate the cash from their sales, because you're supplying power to the TNABs and out to the world. Obviously, your supplier discounting and all of that, receivables and all will pile up. So I think you got to go a bit below just those numbers, and you got to look at it as a sustainable exercise, Prashant. When they say 3 years, I would argue that if you look at to 5 years, that growth will be much faster. That's exactly the thing with operating leverage, isn't it? So I think that, again, when you look 1 year, 2 year, 3 year, it looks like you're overpaying. But when you look with the longer and you project those superior growth rates out that much in the future, the power of compounding, which we talk about in the mutual fund industry, actually comes out in these type of stocks, where I can't talk specifically on that specific stock. You know, regulations don't allow me to. But I think the sector as a whole is in that situation where you're going to have massive cover capacity in India, and there's going to be massive growth, and the capex involved in that and all is a huge spin-off cycle. So I would argue there that, again, the fund manager who's buying that stock is looking at a 5-year horizon. That's why he's comfortable with it. Whereas you look at a 3-year, you're saying, oh, you're already building in the price. You look at 1 year, it obviously looks overpriced. So that's where the whole issue around the infra pack is always that those linear projections, right, of growth are always beaten by these kind of companies in a growth scenario. But the opposite happens when things go bad. So you've got to be very careful.
Sure. Sunil, thank you very much for joining us in this special trading session on Saturday. We need to get to JSW Steel.